What's up, everybody? Welcome to Heresy Financial. My name is Joe Brown, and if you read the title of this video, which you probably did since you clicked on it and you're watching it, you're probably wondering, what the heck? The only thing Joe's been talking about for months now is the coming melt up in the stock market. Last thing you heard, I was projecting 3,800 as the year-end target for the S&P 500, and now all of a sudden I'm short. What is going on? Well, don't worry, it's not net short. I'm actually still net long. That makes a difference. I did take a short position though, and I'll explain that and why. Let's dive in. All right, I talk all the time about how much I like to be hedged, how I look at the entire macroeconomic environment and I make a bet based on what it looks like things are going to do. So right now it looks like gold is going to do really well in the coming inflationary environment that we've been in for a while now and we're going to accelerate into. That is also going to be a tailwind for miners. I've said repeatedly that miners are some of the best valued stocks out of all stocks right now, out of any industry or sector right now, and that it looks like that is going to push all asset prices up, including things like the S&P 500 and housing prices. I still think that. I'm actually still net long the S&P 500 right now through the use of some option plays. However, you can't let opportunities like this pass you up when they come, because by the time you need to hedge, the hedging will be too expensive. If you wait until your house catches on fire to go try and buy fire insurance, it will cost you the same amount as it will to just replace your house. Not really, you won't actually be able to get fire insurance if your house is burning down, but you get the point. Now here's what I mean by you can't let opportunities like this pass you up. Look at the VIX, it's tanking. Look at the market setup. It looks like a very bullish market setup. We've had this big rally since the bottom in March. We've had a giant consolidation for the last few months with a lot of volatility where we had some really big sell-offs that shook out some weak hands. We had a lot of uncertainty leave the market after the election, which has provided a little bit of a boost. And now we are consolidating and the market is squeezing tight. So expected volatility is bleeding out of the market while at the same time we are coiling for an extreme move in one direction or the other. Now, I still think this move is going to be up, but if the move, when we break out of this squeezing consolidation, this coiling that we're going through right now in stocks, if we break down, we're going to break down hard. And so right now, puts are cheap. It is very cheap to buy puts right now. As an example, take a look at these 1,400 strike puts on SPX for December 31st. That's the end of the year. Right now, as of the time of this recording, and it might be different by the time you're looking at this, but right now you could pick these up for about 15 cents if you get them at the midpoint, if you get them at the ask, 20 cents. Now, let's say the market drops to 2,900, which isn't as low as we got in March, but it has been major support and resistance ever since the beginning of 2018. So if we take a big drop, I think there's a decent chance that that's about as low as we go. If that move happens before the end of the year, and you've picked up these 1,400 strike puts, are they in the money? No, they're nowhere near in the money. But a move like that in this short amount of time would spike the price of options all across the board. That'd be a huge spike in volatility. You could easily see these puts go to about $6 a contract. So pick them up for 15, 20 cents with the upside to sell them for $5 or $6. You're risking what you put in, so 1x, 1 times your money, and your potential reward is, somewhere around 25x. And then if we do have a complete breakdown in the market, it only gets better from there. Now, again, I'm not anticipating that this will happen, but the price of these out of the money puts right now is so good that you could easily pick up 50 or 100 contracts for 500 or 1,000 bucks. This means you can not only hedge a stock portfolio, but you can over hedge with a very small amount of money, meaning that if we do have a big drop, you actually start to make money off of the increase in price of these puts. Now, there are other things that you can do in order to lower the cost of these puts as well. You could sell calls, you could turn it into a calendar spread or a diagonal spread. And keep in mind, this is not a recommendation. I just want to be transparent with you guys because I've been expecting and anticipating and telling you guys that I think the market is going to continue to go up from here. And I still do. However, I've just put some more money into some way out of the money puts on the S&P 500 because there is a chance that we have a drop. And I think the chance now, compared with the price of being able to profit off of a drop like that, it's a really good risk reward situation right now. So I just threw a bunch of money into some puts on the S&P 500. Now, if you remember back in November of 2019, so about a year ago now, there was all this news about Ray Dalio taking out a $1.5 billion bet that the market would drop by March of 2020. And everybody was talking about it and saying this is a huge deal. And he came out and he said, we have no such net short bet. And that was true because this was a bet that he was placing in his all-weather fund, which is one of his funds that's designed for stability. And so he wasn't net short the market. He was just placing a bet that would hedge and offset any losses in the long positions in that fund. So you can think of this as a similar thing. You're taking a short bet on the market, but overall in your portfolio, this would just be there to hedge, or the profits from this would take over any losses from the rest of your portfolio, which would be long. Now, if you've never touched options before, I've got a beginner's options course linked in the description below. It's me, it's not somebody else's that I'm recommending. If you haven't taken that and you want to learn about how to use options and you're a straight beginner, you never touched them before, take that options foundations course. If you know the basics of, you've bought puts before, you've bought calls before, but you want to upgrade and be able to do some things like diagonal spreads or iron butterflies to be able to be a little bit more agile and versatile in the kind of strategies that you can deploy, I've got an advanced options course linked in the description below. Again, it's me. It's not somebody else's that I'm recommending. It's linked in the description below. Sign up for that if you want to upgrade your options trading skills. As always, I really appreciate you guys. You're the best. Have a good day.